This LOS is describe the principles of portfolio construction and the role of asset allocation in relation to the IPS, the investment policy statement. The strategic asset allocation. So recall the steps leading towards the strategic asset allocation. On the left-hand side, we've got our long-term capital market expectations. That's the expected returns for different asset classes, the variances, which is risk, and the covariances and correlations. On the right-hand side, you've got the investment policy statement, which has the investor's objectives and constraints. Remember, those are risk and return objectives. And the constraints is LLTTU, liquidity, legal, tax, time, and unique circumstances. Now it sometimes goes into an optimization or simulation to come up with the strategic asset allocation. This is an extra slide. Just want to remind people of an example of some asset allocation, strategic asset allocation. So here's 6, going from left to right, starting with the most secure, which is mostly made up of fixed income and cash. Then as we move to the right, we're reducing the percentage in fixed income and cash, and we're adding equities until we finally get to the far right-hand side. An aggressive growth portfolio would be mostly made up of equities. Balanced portfolio is sometimes like a 60-40, 60% equities, 40% bonds and cash. And again, this is just a quick little example of some typical asset allocation profiles. Steps toward an actual portfolio. So recall 90% of differences in institutional portfolio returns can be explained by target asset allocation. So that's the importance of the asset allocation. And recall, it's not 90% of the returns, it's 90% of the differences in returns. And it's important that I put the word differences in bold, okay? Differences due to asset class weightings are more important than differences from security selection. Actual returns for actively managed accounts are less than target asset allocation returns. This illustrates the difficulty of improving returns by asset allocation or by attempting to select undervalued securities within asset classes. What that's saying is that in very efficient markets, long-term on average, most actively managed accounts haven't outperformed their benchmarks. Steps toward an actual portfolio. Use risk, return, and correlation of asset classes to construct an efficient frontier. Use objectives and constraints from the investment policy statement to select an optimal portfolio, the strategic asset allocation. Tactical asset allocation, which are deviations from the strategic asset allocation, and security selection as permitted and appropriate. Sometimes there's ranges that we can work within. Risk budgeting allocates permitted risk to strategic asset allocation, tactical allocation, and security selection. This slide has 3 different approaches to investing. The first one is passive investment strategies, buy and hold sometimes called. On the equity side, it's just benchmarking, using ETFs, for example. The second is active investment strategies, where you're trying to achieve returns that are greater than a benchmark. And finally, semi-active, risk-controlled, or sometimes called index-enhanced strategies. As time goes on, a client's asset allocation will drift from the target allocation, and the amount of allowable drift, as well as a rebalancing policy, should be formalized. So all the slides for the LOS are done, but I've put in here 10 slides, which is the example from the CFA Level 1 text. And the example is the case of Henri Gascon. And I think this is a very important example to understand at Level 1, because this is really similar to what you need to do in Level 3 with regards to the essay portion, which is half the exam in Level 3. This is very typical of the analysis and some of the calculations that you need to do. Extremely important, good to get up to speed on it in Level 1. So in the case of Henri Gascon, the first thing that we're going to look at is risk tolerance. So Henri is an energy trader who works for a major French oil company based in Paris. He's 30 years old, married with 1 son, aged 5. Mr. Gascon has decided that it's time to review his financial situation and consults a financial advisor. The financial advisor notes the following aspects of Mr. Gascon's situation. He has an annual salary of 250,000 euros, and it's more than sufficient to cover the family's outgoings. He owns his apartment outright, and he has €1 million of savings. He he perceives that his job is reasonably secure. So in the tolerance for risk analysis, we look at not only the willingness to take risk, but also the ability to bear risk. On the willingness to take risk, we want to know how knowledgeable the investor is about financial markets and also get some insight to suggest their risk tolerance, which may be done through a survey. On the ability to bear risk, we look at certain things as the secure job, having high income relative to expenses, significant assets, and the time horizon. In the case of Henri, he has a secure job, 250,000 euro a year income, which he believes is quite secure, and savings of €1 million and also owns his apartment outright. So that would indicate quite a high ability to bear risk. Now we'll look at the return objectives. Having assessed his risk tolerance, Henri now begins to discuss his retirement income needs with a financial advisor. He wishes to retire at age 50, which is 20 years from now. His salary meets current and expected future expenditure requirements, but he does not expect to be able to make any additional pension contributions to his fund. Mr. Gascon sets aside 100,000 euros of his savings as an emergency fund to be held in cash. The remaining 900,000 is to be invested for his retirement. Gascon estimates that a before-tax amount of 2 million euros in today's money will be sufficient to fund his retirement income needs. The financial advisor expects inflation to average 2% per year over the next 20 years. Pension fund contributions and pension fund returns in France are exempt from tax, but pension fund distributions are taxable upon retirement. So we'll just do two quick practice questions to consolidate our understanding. And these are typical of the calculations that you would need to make in CFA Level 3 during the essay portion. So let's have a look. Which of the following is closest to the amount of money Gascon will have to accumulate in nominal terms by his retirement date to meet his retirement income objective, i.e. expressed in money of the day in 20 years? A, 900,000 euros, B, 2 million euros, or C, 3 million euros? And the second question is, which of the following is the closest to the annual rate of return that Gascon must earn on his pension portfolio to meet his retirement income objectives? So these two are closely related. One is asking how much money does he need at the time of his retirement, and the second is, well, what return does he have to earn on the money that he already has to meet that objective? So two quick calculations that we need to do. Mr. Gascon indicated that he believes he needs 2 million euros in today's dollars when he retires. So recall he wants to retire in 20 years, and then inflation is at 2%. So we're going to do 1.02% to the power of 20 times his 2 million, which gives us 2.971895. So that's closest to the 3 million. So that's the answer for the first one. We can bring up our financial calculator here. 1.02 y to the x 20 times our 2 million in today's dollars, euros that he believes he needs. So 2,971,894. Now he knows that he has 900,000 to set aside because he has $1 million in savings, but 100,000 he wants as his emergency fund. So he has 900,000 to invest, and he needs to have 2,971,895. So that's just a time value of money calculation. So we can make that the future value. I know that I've already set the calculator parameter to PY equals 1. So that now that I have that answer up, I can just make that my future value. He also said he's going to make no more payments to the fund. The 900,000 is all that he has. His present value is the 900,000. His savings to the fund will make that a negative present value. And he's going to retire in 20 years, make that the N. Compute the IOI, 6.15, which is closest to the 6.2, okay? And that's all that we needed to do, and that's the type of calculations you need to make in level 3 in the essay portion, just as simple as that. How much money does he need upon retirement? What is the rate of return that he needs to achieve that? So at 2% inflation, 2 million euros in today's money equates to close to 3 million euros in 20 years, 900,000 euros growing at 6.2%, per year for 20 years will accumulate to that 3 million, which is close to the $3 million, which is just above the required amount. So now that we've worked out the risk tolerance and the return objectives, the next thing that we look at in terms of building a portfolio is the constraints on the portfolio selection. Remember, that's the LLTTU. So here we have it. L, legal, L, liquidity, T, tax, T, time horizon, and U, unique circumstances. So we'd have to look at some of these characteristics with regards to the investor. Now we'll look at some facts that may lead to some constraints on portfolio selection. Gascon expects that he will continue to work for the oil company and that his relatively high income will continue for the foreseeable future. Gascon and his wife do not plan to have any additional children, but expect that their son will go to a university at age 18. They expected that their son's education costs can be met out of their salary income. Gascon's emergency reserve of 100,000 euros is expected to be sufficient as a reserve for unforeseen expenditures and emergencies. His retirement savings of 900,000 euros has been contributed to his defined contribution pension plan account to fund his retirement. Under French regulation, pension fund contributions are paid from gross income, i.e., income prior to deduction of tax, and the pension fund returns are exempt from tax. But pension payments from a fund to retirees are taxed as income to the retiree. So let us now go through the constraints analysis. Liquidity, there's no real need for liquidity. He has a relatively high salary, which is meeting all his expenditures. Time horizon, again, approximately 20 years. Tax concerns, his retirement portfolio is exempt from tax. Legal and regulatory factors, it's just following the French pension fund regulations. Unique circumstances, no significant exposure to oil or other commodity stocks because that's the basis of his principal income. Now we're going to look at an outline of a IPS, an investment policy statement. So the following is a simplified excerpt from the IPS the advisor prepares for Henri Gascon and his family, covering objectives and constraints. Risk objectives. The portfolio may take on relatively high amounts of risk in seeking to meet the return requirements. With a 20-year time horizon and significant assets and income, the client has an above-average ability to take risk. The client is a knowledgeable investor with an above-average willingness to take risk. Hence, the client's risk tolerance is above average, explaining the above portfolio risk objective. The portfolio should be well diversified with respect to asset classes and concentration of positions within an asset class. Although the client has above average risk tolerance, his investment assets should be diversified to control the risk of catastrophic loss. Return objectives. The portfolio's long-term requirement is 6.2% per year in nominal terms and net of fees to meet the client's retirement income goal. Finally, we'll look at the constraints portion of the IPS. In terms of liquidity, the portfolio consists of pension fund assets, and there's no need for liquidity in the short to medium term. Time horizon, the portfolio will be invested for a 20-year time horizon. The client intends to retire in 20 years, at which time an income will be drawn from the portfolio. Tax status, under French law, contributions to the fund are made gross of tax and returns in the fund are tax-free. Hence, the client is indifferent between income and capital gains in the fund. Legal and regulatory factors. The management of the portfolio must comply with French pension fund regulations. And finally, unique needs. The client is an executive in the oil industry, so in order to diversify, the portfolio should strive to minimize additional exposure to oil and related stocks. And that's the last slide for this LOS. Thank you.